Well, that was quite the quarter, Bob.
Sure was.
We had Trump's Liberation Day, which was quickly followed by 3 of the worst days in history in April. Looked like we were in for months of tough slugging, but at the end of the day, here we are back the end of June, and markets are right back to historical highs.
Yeah, the markets have sort of shrugged off all of the uncertainty that the tariff activity in the U.S. has really brought to bear, and it seems like nothing much is facing the market right now.
Yeah, investors are certainly complacent. They're taking everything in stride. You've probably heard the acronym TACO, so right now, investors think that Trump's going to back off or chicken out on all of his more harsh policies, which I guess we're starting to see some trade frameworks, but there's a long way from a trade framework to actually getting a trade deal that's meaningful done.
Yeah, I'm not sure that's a sound approach to take, that somehow you can just ignore whatever's his posturing is. I mean, certainly Trump has a negotiating style that's not typical in political realms, but to just simply assume that whatever he says is not going to come to fruition, I think feels like a mistake for investors to be making. And certainly, we're, as you say, seeing that play out right now, that it's just pretty much ignored, and yet we do have some frameworks that have come into effect or are coming into effect. They're not true, complete trade agreements, but I guess the basis for an agreement, and that seems to be enough for the markets to continue to move higher.
Yeah, you mentioned investors potentially making mistakes, and I think sort of this quarter really highlights the dangers of trying to time the market. So investors that got a little freaked out by the market drop in early April, and maybe they sold stocks, raised cash, and those people would be obviously disappointed that they missed out on quite a significant rebound in May and June. So just another highlight of why it's impossible to try and time these markets, particularly with the uncertainty around the Trump administration.
Right. I think timing is generally not a good path to follow, for sure, timing the market. I think in this environment, you still have to be cautious. You have to assume that Trump will and his administration will follow through with some level of tariffs. That's been a common theme for him for a very long period of time. And even you look at this Japanese framework that's just coming into effect. There's a reciprocal tariff at 15%, and that seems to be, maybe a level that's more accepted, at least to some of the larger trading partners going forward. But it's certainly the uncertainty, as we saw in the first quarter, continues to be a concern, or should be a concern for investors into the second half of this year. We've seen the sort of lack of impact of tariffs on the markets through this last quarter. August 1st is the next deadline. Hard to know what's going to happen come August 1st, but certainly the Trump administration is saying that they're going to stick to that deadline and start to apply these tariffs more broadly across many nations, including Canada. So really hard to know what that's going to mean for Canada and the U.S. I think is a big question mark, and certainly you're starting to see some of that data coming through in as far as the impact of initial tariffs on inflation, and you're seeing that in some of the U.S. data now on rising prices, which creates its own issue around interest rates and the broader economy, and of course the U.S. Fed, which is also part of the conversation now. So
yeah, I don't know how many deadlines this August 1st will be, but it's multiple in only a few months, and we've seen all sorts of different numbers on where the tariff will end up: 50%, 10%, 15, 25. It's sort of a revolving door, and I think this uncertainty does a couple things. It makes it very difficult as a business to make long-term decisions, because you just don't know whether the rules of the game are going to be the same tomorrow. And if you're looking at an investment of hundreds of millions of dollars, you're obviously not going to make that until you have more clarity around the environment out there. And then the second thing is you are seeing a bit of an outflow or rebalancing away from the U.S. stock market. And as we know, the U.S. stock market has really been the place to be for quite a number of years. Right. Strong market, technology leaders, strong currency. But I think now some investors are realizing that with a lot of the uncertainty, perhaps it's time to rebalance their portfolios and start lightening up a little bit on exposure to the U.S. That's one of the reasons that international markets have done exceptionally well this year.
Mm-hmm. Yeah, there's no question. Capital flows to where there's perceived safety. And, historically, the U.S. is seen as that safe harbor for capital. I think there's been just an over-allocation into the U.S. markets generally, and now what you've seen through the quarter is, to some degree, as you say, a rebalancing to maybe something closer to a longer-term average. I'm not sure if we're all the way there yet, but that seems to be the path we're on. You've seen, as you say, EFI, so Europe responding, doing much, much better market-wise. Canada has had a stronger year than the U.S., which is interesting, at least in Canadian dollar terms, which is certainly a positive for Canadian investors. But I think still to be seen, right? I mean, certainly the second quarter was, you saw a bounce back in the S&P, which was really a technology-driven bounce back, and really the move towards AI and crypto were the big drivers there in the U.S. market. So hard to know how that's going to play out, but certainly valuations are extended in the U.S. in particular right now, and which would suggest you'll still see more money moving elsewhere to safety. And another reason why gold has been very strong this year is again that perception of safety or insurance against heightened risk, and this behavior of the Trump administration just leaves that risk on the table. And I think until that settles down, maybe we see some further movement on trade agreements in many of the broader trading partners, Canada, Europe, and so on. We're going to just continue to see a lot more uncertainty and risks, and as you say, it translates into all layers of the economy as far as investment of capital and so on.
Yeah, and one of the measuring sticks we really see this is the depreciation in the U.S. dollar against most world currencies. Right. I think the U.S. dollar is down roughly 10% against sort of a basket of the big currencies. And even in Canada, the U.S. dollar depreciated roughly 6% against the loonie. And that, for Canadian investors, it's taken a little bit of a headwind in terms of returns this quarter. And our team spends a lot of time, as you know, Bob, talking about whether we think this shift in currency direction is something that's going to run a while or whether it may reverse. Many of the factors in Canada that would typically argue for a weaker Canadian dollar are certainly apparent. Our economy is likely softening faster than the U.S. Our interest rates are much lower than the U.S. We're at sort of historical lows in terms of the gap. We have weak oil prices. Mm-hmm. And all these factors typically would suggest that the Canadian dollar doesn't perhaps have a whole lot longer to run, but sort of playing out in the background is this long-term trend of perhaps a weakening U.S. dollar that investors have to contend with.
Yeah, I think you're right. It's certainly been a surprise to me to see the Canadian dollar as strong as it has, because the fundamentals don't support it. But again, I think it has less to do with the Canadian dollar strength and more just with the U.S. dollar weakness that's had that shift occur. It does seem very unlikely that that's going to continue for very long anyway, for all the reasons you've already shared. It just doesn't make a lot of sense in a global context. And there's a lot of talk about interest rates and interest rate cuts in the U.S. I know the Trump administration is pushing hard on Powell and the Fed right now, but the reality is that inflation is their one of their two primary responsibilities is managing inflation in the U.S. economy, and inflation, if anything, looks like it's starting to tick up a little bit, which would make it very difficult for the Fed to move, certainly not aggressively. They may make some token reductions in interest rates, but to make any sort of significant shift would be, I think would cause other ramifications for the market, the bond market and the stock market, if they were seen to be bending to Trump's will, without having the right data to support themselves.
Right. I think obviously Canada's in negotiations right now with the U.S. I think Prime Minister Carney has already started to try and reset expectations with Canadians that this will not be a tariff-free deal. There'll be some element of tariffs that impact us, and our dependence on U.S. exports is very important to Canada, and certainly is going to flow through in terms of the currency as well.
No, I think that seems to make a lot of sense, right? If you look at the UK framework, the Japanese framework, there are reciprocal tariffs coming through in those agreements, as if they are that. So to expect that to happen in Canada is probably likely as well. And what that does, of course, again, is it will drive higher inflation, and frankly, it will hurt the U.S. consumer, and as well as the Canadian, for that matter. But that seems to be ignored largely, and it's an unfortunate outcome for, I think, for consumers in North America generally, is that these tariffs it's not a productive way of doing things, but it's just simply another tax that's being levied in a kind of less obvious way.
Yeah, and we're certainly one thing our team's watching sort of over the next couple of weeks, because we're right in the heart of corporate earnings season, is what is the impact on corporate profits, sort of not so much the first half of the year, but what's going to happen in the second half of the year. Some companies, if you look at General Motors, they just reported earnings, and they took over $1 billion hit because of the tariffs. Companies are going to have a difficult decision. Do they eat some of the costs of the tariff and sacrifice their profitability, or do they try and pass along the extra cost of the tariff to the end consumer by raising prices? And obviously, if you raise prices, you run the risk that maybe demand starts to soften for your products or services. So they're sort of caught between a rock and a hard place.
But certainly, historically, what you see is some combination of a pass-through of these higher costs, these tariff costs, and some absorption in margins. But as we know, if to the extent they absorb it into margin means lower earnings, which ultimately would have some impact on returns going forward in the market. And that's something that, again, I think the market's just not pricing in at this point. You've got valuations that are at the higher end of a historic range, and generally, and you've got some earnings impact likely with this trend towards tariffs more broadly across the globe.
Yeah, and certainly, another typical driver of stocks is interest rate policy. Mm-hmm. And as you mentioned earlier, there's pressure from the Trump administration for the U.S. to cut rates, but central banks are in a tough position right now because they know that inflation's going to pick up, as we've sort of talked about, and we've started to see that in some of the most recent economic statistics. But on the other hand, if employment starts to soften, they would typically be lowering rates. So those two different environments typically require a different response from monetary policy. So that's going to be a bit of a balancing act, I think, for both the Bank of Canada and the U.S. Fed.
Very tough place to be right now, to be a Fed governor or the head of the Bank of Canada. Very difficult to try to balance those out, as you say. It seems to me like that means you'll see a slower decline in interest rates from here, at least for the foreseeable future, unless we see a real decline in the economy, either in Canada, the U.S., or both. Right? That would seem to be the likely outcome, which again, has implications from a currency perspective as well. And one of the things that we look at, as you know, is whether we hedge that risk out of client portfolios, because we take performance back into Canadian dollar terms for our Canadian business and U.S. dollar terms for our U.S. business. And we don't have those hedges on right now because we think that there's not a significant risk for continued appreciation, as you've mentioned, and that's something we have to continue to watch. Though is do we think there's a substantial drop or rise for the Canadian dollar or the U.S. dollar in the coming months? And I would say right now we feel kind of in a neutral position on that currency movement perspective.
Yeah, I mean, Canadians have really been benefiting as investors for the last decade from the U.S. dollar that's been very strong, and clearly things have shifted a little bit. But I think it's a bit early to conclude that all of a sudden we're in a period where the Canadian dollar is going to soar. We really don't see that in the cards at this standpoint. No. I think another kicker with all this as it relates to interest rates is the big, beautiful bill that was passed by the Republican Party most recently. And they're adding, I mean, the estimates vary, but probably somewhere in the $3 to $4 trillion range is going to get added to the U.S. debt pile, which is already pretty substantial. And this is a little bit concerning, obviously, to the bond market. As we've sort of talked about, there's probably fewer international investors that are interested in buying U.S. debt right now. So you have a little bit less demand. At the same time, you're going to be amping up supply because we've got to pay for these deficits going forward. So that could also keep longer-term interest rates a little bit higher than they normally would be.
I think that continues to be a higher probability theme for us, this kind of higher for longer interest rate environment than this broader view of interest rates declining at a significant rate over the coming year. It just doesn't feel like that's the path we're on right now. Of course, this is something we have to keep watching all the time, but it just higher for longer feels like the more likely outcome for us.
Yeah, these are, I think, certainly someone that's been in the industry as long as we have. These are not easy times, so I can imagine some of the uncertainty for clients. And I think certainly we feel very strongly that we're well positioned in terms of the diversification that we have. Our focus on dividend growth stocks, which tend to be sort of higher quality, proven businesses that will survive whatever this tariff environment's going to end up being. As you know, we've got lots of exposure to private investments on the credit side, infrastructure, real estate, and even though some of those investments haven't performed quite as well as the public stock market in the last few months, those trends can ebb and flow very quickly. So I think there's going to be a period where that diversification really pays off for our clients.
No question. By design, the private side of what we do is meant to be slow and steady. And of course, again, for a Canadian investor, the U.S. dollar weakness has had I'll say a paper impact because of the short-term movement in currency. But we're seeing really strong performance in our credit strategies right now. Still lots of opportunities to invest in infrastructure and more broadly in private equity. So all of that is working really, really well. But when you get periods of very quick movement in the stock market, as you know, you're going to have a lag period within the privates.
Yeah, absolutely. Obviously, there's going to be winners and losers depending on how this tariff trade situation actually pans out. And certainly our team is looking at the sectors and companies that are going to be beneficiaries of this. Tax cuts that we've seen in the U.S. are going to be stimulative to the U.S. economy and benefit certain areas of the market. Weakness in the U.S. dollar, as we've talked about, and ironically, that's actually good for many of the big multinational companies in the U.S. that have a lot of business outside of the U.S.
You're seeing in both Canada and the U.S. things like increased defense spending, which is very positive, obviously, for the defense sector. We're seeing that coming through in some of the earnings there as well. So it's a period of certainly continued uncertainty, I think, but there are some positives for sure that we continue to look at and have exposure to in many cases. So
yeah, I think good quality companies, they find a way to be profitable and get through these times of uncertainty. The value of their stock may fluctuate up and down through that time, but Eventually, they'll figure out ways to become profitable. And obviously, from a Canadian standpoint, we're probably going to end up with new trade partners to some degree. Certainly, across Canada is the easiest step, but I know the Canadian government's working on getting new suppliers, new customers all over the world.
Yeah, things that we should have done a long time ago. It seems like there's some momentum around, as you say, cutting trade barriers, trade agreement with the EU that's in the works. Our first shipments of LNG, long overdue, but finally now shipping some of our gas production to Asia. So all positives that will certainly help protect Canada and in the coming year.